Hi guys, this is Sarah from The Savvy Professor, and welcome to today's video. We'll talk about a wraparound mortgage. Watch till the end to find out what it is and so much more. What is a wraparound mortgage? A wraparound mortgage is when a homeowner who's yet to complete their mortgage payment sells the house to a buyer who finances the seller. The buyer owes the seller, so the buyer's loan wraps around the seller's existing mortgage. It differs from a traditional mortgage in that the buyer doesn't borrow money from a mortgage lender to pay the seller. The seller loans the buyer at a higher interest rate on top of the increased home value. Therefore, the seller makes a profit. The buyer directly pays the seller in monthly installments. The seller then uses the payments to pay their mortgage and keeps the surplus as profit. For a wraparound mortgage, the mortgage must be assumable and the original mortgage lender must approve. An example of a wraparound mortgage. Let's say that Vanessa bought a house by mortgage for $250,000 at an interest rate of 4% some years ago. She makes monthly payments of about $1,000 to her mortgage lender. Vanessa wants to sell the house and get her lender's approval to do a wraparound. She sells the house to a buyer, Michael, at $350,000, a 6% interest rate, and a down payment of $50,000. Monthly, Michael will send Vanessa around $1,450 to cover her $1,000 payment to her mortgage lender, plus $450 profit. Pros and cons of a wraparound mortgage. A wraparound mortgage is beneficial to both the buyer and seller. It enables the buyer to own a home if they don't qualify for a traditional mortgage, and the seller makes a profit. However, due to the high interest rate, a wraparound mortgage may be more expensive than a traditional mortgage. If the buyer defaults on their monthly payment to the seller will have to pay the original lender out of their pocket. If the seller defaults on their monthly payment to the original lender, the lender may foreclose the house and the buyer could be evicted. To avoid this, the buyer can make some direct payments to the original mortgage lender. So, there you have it. A wraparound mortgage is an alternative for buyers who don't qualify for traditional mortgages. It is advisable to involve a real estate attorney throughout the process. I hope this video was helpful, and if so, feel free to like, share, and leave a comment. Till next time.